Um, okay, welcome everyone and good afternoon. And thank you for joining us today for this session that we're having organized by the NBA-SBL Taxation Committee. As we all know, this session we're looking at the recent fiscal developments in Nigeria and the sectors that are affected. We all know that the country today, as it is such that taxation and issues related to tax is a right in the front burner. And as such, the NBA-SBL Tax Committee has seen it fit that we bring these issues for discussion and to throw more light on the issues, right? Today we have, as part of our panelists, from the regulator, the Federal Inland Revenue Service is here with us. We have consultants here that are leading the charge in advisory support for people in the industry. We have people here who have also been involved in drafting legislation, right? And some of the amendments that we have seen in the Finance Act are also here with us. So we are hoping that we would have a very robust session, and it will be very insightful. We will leave you with lots of takeaways that would be of serious impact and significance to our practice. Quickly, I would just like to introduce our panelists that are here with us today. We have Ugochi Ndebio. Ugochi is an associate director within the Corporate Tax Consulting Practice Group of PwC here in Nigeria. She's a seasoned tax practitioner with legal and accounting background. And when I see people with legal and accounting background, I always say you have the double advantage, and that's what we have here today. She's also the head of Regulatory Business Solutions and Tax Controversy and Dispute Resolution Unit. She has over 15 years experience in leading various tax policy advocacy engagements. She has been providing tax and regulatory advisory support to both multinationals and indigenous companies in various sectors here in Nigeria. And we're happy to have you join us today. We also have, as part of our panelists, Chinwendu Enechi. Chinwendu Enechi is a partner in the oil, gas, and power practice of Anderson, Nigeria. He specializes in providing workable tax management and advisory solutions to companies in the oil and gas industry here in Nigeria. Chinwendu also has over 15 years experience in covering corporate tax planning, advisory, compliance work for local and multinational companies in various industries. Chinwendu has been involved in personal income tax planning, advisory compliance work across different sectors, sector. He has worked with very high net worth individuals, multinationals, and had helped planning for all these entities. He's a team leader in the provision of several tax due diligence services in the Nigerian oil and gas company. We know that this is a sector that's had a lot of traction recently with the passing of the PIA, which was long in coming, and he played a significant role in this area. We also have with us Mr. Femi Olarinde. Mr. Femi Olarinde comes from the regulator, which is the Federal Inland Revenue Service. Mr. Femi Olarinde is the tax policy expert and a multidisciplinary professional who holds a bachelor's degree in banking and finance and a master's degree in financial management. He's a chartered accountant, chartered tax associate, and chartered human resource personnel. He's the assistant director in the Federal Inland Revenue Services and presently the technical assistant on tax policy to the executive chairman of the FIRS. So you see, we have the right people here to speak to us on these issues that are burning, especially from the regulator, the Federal Inland Revenue Service. And we have someone from the tax policy department that is here with us to throw light on issues that I know is burning in the minds of many of us. So welcome everyone, and thank you for joining us. For participants that have joined us, we already have a lot of participants that have joined. We are hoping that you would have, your time will be worthwhile and you would learn a thing or two from today's session. So without further ado, we'd like to jump right into it. And I would like to start with Ugochi. My first question goes to Ugochi. We are aware that the FRS recently issued a circular, right? And that's what this question is dealing for LLPs. So we have noted from the circular that the FRS position is that LLPs should be taxed as companies, right? And I know when this came out, it hit a lot of people like, what's happening here? So we've noticed that the FRS position is that LLPs should be taxed as companies and not as tax transparent or pass-through vehicles, which many lawyers have advised previously, as is applicable in other jurisdictions. How do you foresee FRS's position impacting investment funds operating in or investing in Nigeria? Which would like you to throw light on this, because when the FRS issued this circular, it just sent some waves, because we were like, I mean, like in other jurisdictions, other civilized jurisdictions like Nigeria, the understanding of an LLP is pretty clear and how things are treated there. But we see that the FRS position is slightly different here. We would like your thoughts on this. Thank you, Gucci.
All right, thanks a lot, Samuel. I'm actually very happy to be here. It feels like I'm back home. So thanks for the question too as well. And I do agree with you that when this circular came out last year, in fact, it really took everyone by surprise, because when we were all clamoring for the inclusion of the LLP in the CAMA in 2020, the understanding we had was that we wanted to position Nigeria to also benefit from the advanced countries like the UK, the US, Singapore, that have this structure that enables certain kinds of businesses to have the fluidity of partnerships, but at the same time, take the benefits of having it being under a corporate organization where your liability is limited, and at the same time, you're able to have tax transparency, because largely this is how it applies in most places. Now, I must be frank to say that Nigeria is not the first place that has, decided that this is not going to be a tax transparent kind of entity. So I know that the likes of India and I think Mexico as well have also taken this stand in the past. So we're not the first. And it's also a burning issue globally. Now, it's a burning issue globally because of two reasons. It's been seen in the past to result in sometimes non-taxation at all. So if there's a way you can structure it in a way that it passes through several jurisdictions, where it's a pass-through entity, and then you end up not having any tax applied. But that's part of the reason why the OECD, the Pillar 2, was also trying to capture that, to make sure that you don't have those instances where it's not taxed. So now we then have an issue where it's resulting in a lot of instances in double taxation, where the investment is taxed at the level of the LLP and then taxed again in the hands of the recipients. Now, we do know that mostly when the LLP is usually utilized by the investment funds and service providers. And the import of the reason why that kind of structure works is because essentially the investment funds just house funds, help you to invest it. And it's the ultimate beneficiary that takes all the profits. So most times they just mop up the profits up. And so the question is, why tax it down there and then tax it up again? So you then have this stance where the FRS has taken this stance, and then it really then begs the question really from a tax policy standpoint, what really is the essence of having the LLP structure in Nigeria? Because if it then defeats the one of the critical issues or one of the critical reasons why we set it up, of what use is it? What's the attractiveness? So between 2021, when they started registering to date, I don't know of many. many, LLPs that have been registered. And this is one of the primary reasons, because the question is, why do I want to complicate my tax issues? If I'm going to be taxed here and then say, for example, I take my investors are sitting in the UK where they are also going to be taxed, what then happens? For the most part, what I'll have is a high effective tax rate. So those issues are the things that I see that is impacting on the utilization of this kind of legal structure and makes it highly unattractive for investors currently.
Yeah, thank you, Gochi. So, I mean, what I hear you say is, I mean, which you appear to conclude with is this kind of position, it makes it again unattractive for investors, basically, coming into Nigeria. So, just as a follow-up to that, right, I would like to ask, are there specific challenges, right, or opportunities, not just challenges? Are there challenges or opportunities? Because I imagine the FIRS must have seen an opportunity there or seen a plus there for coming out with their position, right? So we would like to hear from you. Are there challenges, the challenges and the opportunities that this position that the FIRS has come up with would present for LLPs and especially investment funds in Nigeria?
Okay, I think the challenges are glaring. I had already started to touch on it when I initially spoke, and that's around the issue of the double taxation that may likely occur for the investors, where the LLP is taxed as an entity, and not just taxed as an entity, taxed at a higher tax rate, tax band. So if you look at general partnerships in Nigeria, you typically at the highest tax band is 24%. So effectively, you may be paying maybe 20 to 22%. But then if you then have it as an LLP where you be taxed at the LLP level, LLP, I mean, the circular is clear. You're going to be taxed at, well, for the most part, because for the most part, the income is going to be, the revenue is going to be larger than 100 million, right? Because if it's more than 100 million, then it's okay, maybe 20%. But for most investment funds that want to use this, their revenue is likely going to be in the higher tax bracket. So you're looking at a taxation of about 30%. They're going to be also liable to tertiary education tax. You're also going to be liable to the Police Trust Fund Act. Depending on the business you do, that's any may also fall in line. So already you have a higher tax bracket or a tax rate that you're paying. And then the investors, again, at the point when you're remitting their profits, is also the FIRS circular says that to be treated as dividends. So another 10% is going to be suffered, or 10% is going to be suffered by the investors before they then extract the profit out of it. And for most investors outside Nigeria, most of them will probably be sitting in jurisdictions where they're also taxable. And then you then have, tax again apply. For some of them, they will be able to get some kind of tax credits where they're able to net off the withholding tax. But the level of the taxation at the LLP, that is completely lost. And so it results in a higher tax rate for them, effective tax rate, essentially. So that's a challenge. The question is, of what use them do I have to? I mean, I'm looking at what's the benefits of them using it. So I know, one of the benefits that typically people would have said is, okay, there's a bit of flexibility around the ownership, around management, maybe, and distribution of profits. Yes, those are there, but not from a tax perspective. So those still exist. From a tax perspective, maybe you say, okay, if they fall within the lower tax bracket, they may pay, CIT at 20%. For me, honestly, maybe enjoy some tax incentives that will flow naturally to a company, but those are not the things that most investment funds are looking to enjoy. So from the perspective of an investment fund, I struggle to see the opportunities, but more of challenges that they're going to face if they want to utilize this kind of structure. But I'm happy to hear Mr. Femi to understand how the FIRS, what they were thinking behind this was really.
Yeah, thank you very much, Gochi. Absolutely. And that is one of the reasons why we have Mr. Femi here with us. And you see, to the point you make, and that's why we have the FRS anyway, to speak to the reasoning, right, behind this position that that it has taken. Especially now that when you look at the figures we get from the Bureau of Statistics on capital implementation, some of the drop that we've had with those figures here and there, you are wondering, is this the kind of policy you want to, the kind of vibes you want to have coming out of the country from the tax regulator? But let me not prejudice what Mr. Femi is going to say. Mr. Femi, over to you. We would like to hear you respond to the points that Ugochi has made, and would like you to speak to what was you think informed the FIRS's reasoning to come up with this position. Thank you.
Okay, thank you very much, Sam, and thank you, everyone. Thank you for having me. Thank you, Ugochi. You have actually spoken like an advisor to a businessman, and that is what you do. That's your work, and I quite appreciate that. Be as it may, you have also spoken about both the merit and demerits, what the gains are, even outside tax. So I'm sure as a businessman, when you want to set up your business structure, you need to look at the implication vis-a-vis whether taxation and other benefits. And even the World Bank in the ranking have said taxation may not be the first or second or third to consider when you are looking at a business decision. Well, it's still an argument that some other people have tried to debunk. Now, I would like to share something with us. First, I would like to start from to state that tax itself, taxation is law, and the application of taxes must be provided for by the law. So whatever you want to speak about a tax, it's what the law must strictly provide for, whether it's the treatment, the exemption, whatever it is. Now, when you look at the provision of Section 24 of our grand norm, the Constitution, it states that it shall be the duty of every citizen of Nigeria in paragraph F to declare his income honestly and to the appropriate and lawful agencies and pay his tax promptly. Now, where am I going to? Appropriate and lawful agency, which means there are levels of taxation in Nigeria and levels of persons who have been saddled with the administration of different levels of taxes. Now, consequently, when you go to the second schedule, part 1 of the exclusive, part 1, which states the exclusive legislative list in the Constitution, item number 59 specifically lists taxation of incomes, profit and gains as item on the exclusive list, which means that the National Assembly have the power to legislate over such matters. And the National Assembly has enacted what we call the Companies Income Tax Act and Personal Income Tax Act to delineate the jurisdiction of taxes. And what it means is that when such income is earned by a company, when such income pertains to a company, it goes to the federal government, irrespective of the form or structure of business. So we can't leave those provisions of the law and now talking about practice in other jurisdictions. And mind you, we do not operate a law of other jurisdiction. And I know you are all lawyers, this is very clear. And I think that is the first and foundational basis for this. If the law wants to so provide for other treatment for some form or structure, the law will clearly state, whether in the main law or in a subsidiary legislation. Also, of course, we don't do circulars, or FIRs do not work in isolation with without hearing from other stakeholders. There were consultations with the CAC to know actually why this provision, what was the basis and the understanding of FIS got led to the understanding they are also providing. And like you have said, I'm sure you have not, the position that we've taken is a position we believe that the law supports. And that is why FIS have taken this position. I am not, let me also give, I am not on this panel to defend FIRS or to be an FIS spokesman, but of course, as a senior member of the service, I can tell you the position, I can explain and defend some of those positions that FIS have taken, and to the best of my knowledge, this is how I believe I have answered your question appropriately. Thank you.
Okay, thank you, Mr. Femi. I would say that it appears that we'll have a lot more things to query in the response we just heard as to all that. And it's interesting to note as you speak to it, right, that when you talked about consultation, I was eager to hear the extent of consultation that was done. And I see you mentioned the Corporate Affairs Commission, which is another government regulator again. But we would leave that. I don't know, Ugochi, do you want to make just a quick response to any of the points that Mr. Femi has made, just maybe for a minute?
Yes, so I think what I want to say to that is this. Now, personally, I see the basis that they choose to impose taxes on LLPs. However, I think that's a very strict interpretation. Now, because if you look at the CIT, it defines companies that are going to be subjected to tax under the CIT as companies and corporations. Now, that word corporation is not defined in our laws. Now, I know on the general assumption, they say it's a legal entity, a corporate entity, you know, that is set up by law. However, we also have a provision within the PITA that talks about the taxation of partnerships, that brings taxation of regular partnerships under the PITA regime. And that is the basis that people have always assumed that, okay, yes, I do agree that in most jurisdictions where you have the taxation, for the most part, it's spelled out to say taxation of LLPs will be, you know, it will be the final recipients that are going to be subject to taxation. However, the way our tax law is currently loosely worded, there is scope to implement or to give an interpretation that works beneficially for both the government and the business people. Now, if we say, oh, it was just the CAC, like you said, that we did, liaise with in coming up with our stakeholders, CAC will naturally toe the line of government. And the complications that we see, the question we ask ourselves then of what, the reason why laws are put in place is that there's a reason why some of these things come into play. And if you don't, the reason why you then have the LLP is to, for the most part, is to have that tax transparency. And then you frustrate the process by saying you're taking a strict interpretation. That's as the essence of that law. You've lost the essence. Yeah. When we could have taken a inner interpretation that could have given maximum effect to that law. So, Mr. Femi, I think the question to you was the FIRS. I mean, I hear you when you say, oh, FIRS could have, but there are also interpretations that could have suggested otherwise to make sure that, that the full intent of creating that kind of legal structure is given effect to. And I don't think that the strict interpretation that the FIRS has currently taken gives effect to that. It just completely makes a mockery of the entire LLP system.
Thank you, Gochi. I guess we can go on and on this, but the points are well noted, right? And because the understanding for and LLP has always been clear. But I guess these are issues that maybe the FRS will need to come with more clarity on. And you want to also see if it makes business sense or if it helps the economy at this time, especially when we are trying to attract more investment into the country. But we'll leave that for another time. I would like to jump to our next panelist, Chinwendu, and go into oil and gas. We see that the government recently passed an executive order, right, that gave certain specific incentives to the gas industry. And that's what we want to ask you a question on. So, Chinwendu, we want to know your thoughts. So, can you speak to us on what are the anticipated impacts of these incentives, right, that the federal government has put in this executive order for the non-associated gas greenfield developments? Also, we would like to know, are there any projections, right, on how these incentives might influence the pace or scale of development in the midstream oil and gas industry? Let's hear your thoughts on this.
All right, thank you so much, Samuel. I mean, if you ask me, the executive orders are a welcome development, really, because the whole essence is to kind of position the country as a preferred investment destination, and of course, attract investment, reduce contracting cost and timeline, and then promote cost efficiency. The order came with, 3 fiscal directives, which for me are very, very important. But speaking to just the question that you asked, which for me is on the fiscal and how that impacts investments. Obviously, I mean, if I'm speaking to some of my clients, there are already reactions to that. For those who have gas investments, or those who had anticipated to go into that area of investment, and for some reason delayed that. What this executive order has done is to more like, bring that conversation to the front burner. Because if you look at the incentives that have been granted, the whole essence is to encourage investment in that space. If I speak to some of it, like the gas tax credit, is something that we've never had before. And so to present that, and in addition to the allowance that you also have, the gas utilization investment allowance encourages investment in that space. If you look at the Finance Act of 2023, for instance, we used to have investment allowance for plant and equipment. Finance Act kind of, took that out. I think what this order has done is to introduce that, but particularly for the guys in the midstream and downstream operations. So, I mean, what we see, or what we anticipate to see, is some action in that space, where investors then begin to look at that space, or for any investment that had been put on hold before. What you want to see now is, conversations around that. The fiscal incentive is a significant positive development for that industry, because of course, what you want to see is going to stimulate growth in the midstream sector. And we're already beginning to see, like I said, I've had conversations with some of my clients who have had, gas projects that have been put on the back burner for a while, because of non-favorable incentives, in their own words. And seeing this executive order, what it does is that it brings that conversation up, and everybody's looking to see how they can play there. Now, if you look at in the industry currently, we've had lots of divestment by the IOCs. They are all moving towards the deep offshore. If you look at what part of the executive order also speaks to operations within the deep offshore. So you want to see more investment in that area, given the fact that the government is, showing the intent to encourage investors with the incentives that they have been granted. For the deep offshore, for instance, the goal there is to kind of achieve a competitive internal rate of return for investors within that space. So don't be surprised when you begin to see the guys who have divested from onshore and shallow waters begin to make significant investment in the deep offshore, given what the posture, from the government that the Nigeria is interested in, bringing more investors in that space. And what this executive order does is essentially to, signal that intention and, essentially tell investors that, look, we're ready for business. And we are more or less trying to create an enabling environment that we seem to be attractive to investors.
Thank you very much, Chinwendu. Thank you very much. I guess a follow-up to that, right, is to ask you, so there have been other incentives for this industry prior to this executive order, obviously. So we just like to hear your thoughts, right? How does this now differ from what is in the PIA, the Petroleum Industry Act, or CITA, or what has been there prior to this order? Basically, are there overlaps? There are conflicts? Are there things we should look out for in this area? Do we need to be concerned about what has already been provided already in the act? Does a company in this industry need to be concerned about an incentive it has already enjoyed or it's enjoying if it's supposed to, reap the benefits of this executive order that you've explained now?
Thank you so much for that question. If I start with the first one, the gas tax credit, it's a new one. So obviously there is no overlap, in that respect, because it's something completely new. So it's a new incentive that has been introduced by the government. And I think it's something that the expectation is that you want to see that spur investment in that space. If you look at the utilization investment allowance, I think I did mention that in the past, we used to have investment allowance on plant and equipment, which has now been taken out by Finance Act of 2023. But so what you have now, it's an increased rate. In the past, we used to have 10%, but now what the executive order is proposing is 25%. So for me, that's an increase from what we used to have. Although companies who who acquired access prior to this executive order or prior to the Finance Act of 2023 are still eligible, will still be able to claim investment allowance. Although, of course, the law says you have to claim it in the first year that you acquired that asset, and that asset was put to use. But we've seen instances where, for some reason, and I'm sure Mr. Femi can attest to that, the company maybe failed to claim it. You can always make a case to the FRS, to kind of refile your taxes and claim that incentive if it's still within the time frame. Now, on the investment tax allowance, of course, there's a proviso to that because in the PIA, companies within this same space, the midstream project, for instance, are also entitled to the incentives that you have in Section 39(1) of the Companies Income Tax Act. So what the order is saying is that, look, even though you are entitled to this investment allowance, if you're already enjoying the incentives under Section 39, you're going to have to wait because that gives you a tax-free period. You're going to have to wait until that tax-free period is exhausted. So you can't enjoy both incentives at the same time. And of course, there's also a proviso added to it to say, look, if within 5 years of acquiring that asset, you then sell the same asset to someone else that is doing something completely unrelated to what you were doing, you will not be eligible for that incentive. Or if for some reason, the only reason you acquired that asset was to kind of restructure your transaction and enjoy that benefit, but not necessarily because you're making significant investment in the gas space. The FRSB, treat that as an artificial transaction, or to say, look, that transaction is fictitious. So in terms of the fiscal, there is no overlap. What I would like to say is that it's an executive order. And what we would like to see is a situation where the National Assembly then goes ahead to amend the existing laws to reflect these incentives such that you won't have any case of someone arguing whether it is contrary to the existing law. But what you want to see is a situation where the National Assembly then takes it and kind of embed these incentives into the existing laws, so we can have something that is long lasting and gives comfort to investors, really. So to answer your question, there's really no overlap. We have new incentives that have been granted. We have an incentive that is replacing something that was repealed by the Finance Act, and of course, increasing the rates. But that's for new asset acquisition subsequent to the executive order. For assets that were acquired prior to that, obviously will not enjoy that incentive because they need to be acquired within the period that the executive order is active. So I don't think there's any overlap. I would think that it's something that is very much welcoming. Some of them are different from what we used to have in the PIA, both in the PIA, in the PPTA, and the SITA. The SITA still has the Section 39(1), and like I said, the executive order has made reference to that to say, look, you can enjoy both. You cannot enjoy both. You have to wait till the Section 39(1) incentives are exhausted before you can then enjoy the investment allowance. But mind you, the investment allowance can only be enjoyed in the first year the asset was acquired. So I think investors also need to be mindful of that, because if you're already enjoying Section 39 during which you acquired the asset, the question then is, okay, is it possible for you to then enjoy the incentives after the first day was acquired? Is it possible for you to treat that asset after your tax-free period as if they were acquired on the day, after the end of the tax-free period? I'm sure Mr. Femi can also speak to that to see if a case can be made in that respect. But the executive order is very clear on what needs to happen, which is the fact that you can't enjoy both incentives. You've got to wait for the Section 39(1) tax holiday to end before you're eligible to the incentives.
Okay, thank you very much, Chinwendu. I think the last point you've made flows into the next question, which we want to ask Mr. Femi, who is here from FIRS, to clarify. It's interesting that Chinwendu makes the point on the need for the National Assembly to make these amendments and all that. But from the FIRS, and this is to you, Mr. Femi, what role can the FIRS play, right, in creating certainty as to the application or application of this executive order, of these incentives, right, in this executive order? And we ask this because we have seen where the federal government have had other executive orders, right, which the FIRS, when certain companies have taken benefit of those, right, the FIRS have subsequently challenged them taking the benefit for whatever reason or the other. I mean, you have the road construction refurbishment investment tax incentive. You have the incentive that deals with exemption of bonds and short-term government securities and all that. Certain entities that enjoyed these executive orders subsequently had challenges with the FIRS. So the question is, what role is the FIRS playing to create certainty in the minds of taxpayers with respect to the application of this executive order and the incentives there?
Okay, thank you, Sam. And before I go to that question, when I finished speaking, you gave Ugochi another time to speak about the same subject, and which she made she said some things which I think I need to respond. The first one she said is the intention of creating the LLP it has been cannot be seen based on the treatment FIRS is giving it. I am sure for as many lawyers are on this platform, they say there's no intendment in law, which means that you cannot say you are not the one determining what the intention is based on your own understanding. And you too, Sam, you said something about the understanding of LLP. Okay. Ugochi also said the normal partnership being taxed. under the Personal Income Tax Act. We know normal partnerships are by individuals, which the Personal Income Tax Act already provides for. So when companies are coming together, so when you say you want a couple, and the couple are, let me say couples, single couples, boyfriend and girlfriend, and married people, you treat them the same way. I'm sure that's an understanding we need to get first. And you also said, Sam, the understanding of LLP is clear. It's not clear because we are just getting that in Nigeria because of those provisions. And we cannot just take a treatment based on what we perceive it to be. And like Ugochi also agreed to, where the laws wants to provide for something, it will clearly state for that. And we cannot think about just saying, oh, because of the fact that this is how they said it should be so. We need to follow the provisions of the law, and that is the reason why FRS have taken that position. Now, let me go to your question. You said why the FRS seems to have problem with some incentive that has been granted to taxpayers. I would like to put on note that FRS is a statutory organization set up by law of the Federal Republic of Nigeria, and we always uphold the law at all times. Now, FRS role is to implement incentives already set out in the law, and we do implement them to the best of our ability. However, a critical role of FRS is also to account for revenues accrued to the Federation and to governments of Nigeria. Hence, the duty to ensure that the proper management of some incentives that may impact on such accounting. So if the way someone is taking an incentive, we are not saying, no, those incentives are not for you. You can take it. The law has allowed you. But sometimes we need to see, how did you take it? And that is the only thing FIS has been doing, to ask, oh, how was this administered? And to ask some questions too. And this is what everyone calls a probe, just a little probe, not stopping what the law has granted. We can't stop. We do not have that power to stop what the law has granted. And when we speak about it, it's just to say, oh, let's review it. But I'm sure we have never stopped anything the law has spoken about. You talk about the exemption on bonds, and FIS never stopped that until it expired. We did not stop it until the thing expired, and it has expired, and it is gone for today. So why are we still talking about it? Until it comes back into a law, we can administer that. So like I said, when an incentive is granted to the industry, the only role the FIS have is to implement it. And in implementing it, definitely, we have to implement it in the way that it shows all forms of transparency, that shows that it is transparent. The implementation is transparent, and where there are questions, as tax authority that needs to account for such taxes, we need to also ask questions. And that is what FIS have been doing all through when in regards to incentive management. Thank you.
Thank you, Mr. Femi. I'm not, in the words of lawyers, I'm not going to join issues with you again because of time. I want us to move very quickly just because of time. There's another question, a few more questions we want to ask, right? I'll just try and put them in one. And I'll want Ugochi and Chinwendu to just quickly speak to them, maybe one minute each, right? So this has to do with companies that have been, how companies have been impacted by the losses as a result of FX. And we've seen that in the first quarter of this year, companies have been declaring losses as a result of the volatility for FX in Nigeria and the policy of the CBN floating the Naira, right? And it has had impact on taxpayers and companies, on businesses across the country. So we just want you to speak very briefly from a tax perspective, basically. What are the risks? What impacts are there, tax implications, what this could be? What are the risks that this could portend for these companies and the impact this may have? So Ugochi first, then Chinwendu, very briefly.
Thank you, Samuel. I don't know how I'm going to do this in 1 minute. When you said 1 minute, I started struggling with it because I think we need to break down this a bit so that our listeners are able to appreciate it. And to be able to then get to the points, we need to then have that, understanding. Now, for how the FX losses impact companies, I'll try to break it down as simple as possible. I assume I bought a good today, maybe say in January of 2023. Assume at that point, the foreign exchange, I bought it $1,000 and the exchange rate was at 400. Now, at that point where I bought it, I'll record it in my books now. Under the International Financial Reporting Standard, there's something you call your functional currency. So Nigerian companies are required to report in Naira. So I bought it in $1,000, but I have to report it in Naira. So at the point when I bought it in January 2023, assuming the FX, the exchange rate was maybe going for 400 to $1, I'll report it at 400,000 as at January. Now, assuming two instances, assuming I pay for half of the goods by June, say FX had risen to 600, that means on a monthly basis, I'm supposed to retranslate my liability for that payment I haven't made. So on a monthly basis, I'm supposed to retranslate it. By the time I'm making part payments in June, the entire liability is no longer 400, it's now 600,000, right? And say I pay half of it. So I pay 300,000. At that point where I paid 300,000, by rights, based on the way I had already recognized it, I should have paid only 200, but I've paid 300 now. So I already have an FX loss of 100, which I'm going to pass through my financial statements, and it's going to account as a loss for me. Now, at the point when I get to the end of the year, if I still haven't paid it, FX is now, say, 1,000. All of a sudden, I have to retranslate it. I'm carrying 1 million in my books as against the original 400. Okay, say I paid half of it. So I'm carrying 500 now in my books as against the original 200 I'm supposed to have been carried in my books. From a financial reporting perspective, and to translate to your, whether you're making profits or you're making losses, I have incurred losses as at the end of 2023 of, that's about, I think about 700. So I'm carrying those FX losses. It's hitting my profits. So already, despite the fact that I may or may not even have fully incurred it, I've already suffered that loss from a financial reporting perspective. So companies that are significantly dependent on imports, like manufacturing, like the telecom that utilize maybe a lot of foreign services, those are hugely seeing a lot of financial, FX related losses. Now, from a tax perspective, it then slightly varies because from a taxman standpoint, they'll say your expenses can only be fully deductible when it's wholly, reasonably exclusively and necessarily incurred. And the question is always, if I haven't fully settled that liability, have I really incurred that FX loss I'm carrying in my books? From a tax standpoint, the answer may be no, I haven't fully incurred it. So you then find that there may be instances where I have suffered significant losses, but from a tax perspective, I'm unable to take that benefit because I haven't fully realized it. So that's why you now have the difference between your realized FX losses and your unrealized FX losses. From a tax standpoint, the taxman is affecting the IFRS to say it's only the one that is realized that you can claim. The one that's unrealized, it has hit my books. I have suffered from it, but I'm unable to take that benefit. So you don't see that companies are in jeopardy. They are suffering, they are making losses, but from a tax standpoint, they can't even get that breather to say, okay, I'm supposed to take it as a deductible loss. They have to carry it into the future. We don't know what the future is going to hold. So that's why you have that risk where companies are carrying huge losses, but from a tax standpoint, they can't enjoy the benefits of those losses. So it's almost like a double jeopardy where I'm hit and I'm hit again. So that is a simple explanation to why it's a big issue, particularly in this period of tax volatility. So from a tax standpoint, the question is, am I able to then make sure I document it to make sure I'm able to claim the tax, to make sure that I'm able to get full tax deductibility. So that is in terms of the risks and how it plays out.
Thank you very much. Good. Chinwe, do you want to just maybe 2 minutes this time, please? If you
Yeah.
can. Thank you.
Yeah, and thanks to Gucci. I think she's kind of laid a very good foundation in responding to the issue. In terms of FX losses, it all depends on which industry you play in. If you look at the banks, for instance, most of them are declaring profits, you know. But when you look at the manufacturing and those who like Gucci said, need to use foreign services and you have to pay in foreign exchange, a lot of them are reporting losses. So the question then is, how much of that loss can I take as a deduction for tax purposes, which is where, like Ugochi said, what is realized and what is unrealized. Unfortunately, like Ugochi mentioned as well, that the supposed unrealized exchange losses are not allowable for tax deduction, because the question then is, what if tomorrow the exchange rate then goes in your favor? What you have as a loss could, change to become a gain. So until the transaction is complete and the losses or gains have been realized, the treatment can be different. So the question then is, what do you need to do? What can companies do, to kind of deal with this issue? It's pretty difficult, really. Sometimes the best strategies, particularly the best strategy, may not even work in our current environment where exchange rates, is so volatile. Like today is maybe it's 500, tomorrow is 700, the next day is 1,000. So what do you do? Well, of course, you can then implement some strategies, to see how you can then reduce the impact. And some companies kind of adopted that. You can kind of reconsider your operating structure, for instance, to optimize your tax position and in response to FX volatility. And what would you do? You can then restructure intercompany transaction, for instance, for companies that have related party transactions, or reevaluate your location. We've seen some companies leave Nigeria, because of this kind of issue. So you can reevaluate the location of your assets and on an operation to minimize that tax exposure from a group perspective. Of course, when you have related party transaction, you also need to then look at your transfer pricing consideration as well, to see the rate that you had agreed, to offer services or to receive services within your group, given the FX issues may then have to change, because FRS may tell you that in Naira terms, that is no longer reasonable, when compared to maybe other companies. So there's a whole lot that companies are then faced with in terms of responding to these FX issues. And then to mitigate that, you may then need to look at some hedging instrument to see how you can, deal with it. Part of which is to say, okay, maybe you want to settle your invoices quickly while the rate favors you. Or maybe in some instances, if you think that you have very good information that says that the exchange rate might reduce, you may want to then delay, settlement of your invoice. So there are different approaches that people adopt depending on your own circumstance. But I think it's a big issue, particularly to the guys in the manufacturing industry, because you can have very huge FX losses. And we've seen lots of those manufacturing companies reporting losses recently due to, and most of those losses are coming from exchange rates. But unfortunately, some of those losses may not be able to take deductions for them because they are not realized yet. So that's the issue that these companies are faced with, really. I don't know if FRS would be lenient enough to allow them to take a deduction, because again, the question is always, look, what if tomorrow the exchange rates then differs? Quite recently, exchange rate moves from 1,800. We're hearing about 1,300. So that's like a 500 Naira difference already. So if a company who was reporting a loss, with the 1,800, that loss would have reduced in a matter of days. So that's the issue that companies are faced with this volatility.
Yeah, thank you, Chinwendu. Well, very well said. I'll just speak to the audience that you can, if you have questions, we'll be able to take 1 or 2 questions. You can put it in the chat, in the chat box. So Mr. Femi, we'll come to you now. How does the FRS want to deal with all this that taxpayers are facing? Because it's a real issue and it's affecting their businesses. I mean, we heard Chinwendu spoke, of which some companies are already doing, are thinking of, you know what, let's move out of the country. What's the FRS saying?
Okay. Well, thank you. Even from all Chinwendu, is it Chinwendu? Yes, said, it's obvious that the problem is not a tax problem. It's not a taxation problem. And of course, from what Gochi said, you cannot give from what you don't have. So if you are asking me that when a tax has not been realized, a loss has not been realized, you want to take it, you know, I don't see how we want to allow that. So when you said, Chiwedu now said whether FRS we allow. So when I started this, my presentation earlier, I was talking about tax being a law, and every provision for taxation has to be well legislated. So what it simply means, if FRS is allowing all forms of deduction, is simply doing what is outside the law, which these are deductions that the law already provided for. Ugochi spoke about the application of the REM principle, which is a deduction must be only reasonable, excessive, and necessarily incurred for the production of a particular profit to which you are taxing. So if you have not earned a profit, how do you tax such profit? How do you now take the loss from another profit, the loss which you have not earned from a profit you've earned? So it's tough to comprehend this, and it's very alien to the law. And FRS, the only thing we have to do, like I said, we are just we implement the law. We implement the law. Places where the law gives us discretion, I'm sure we have tried to use it. And that is talking about penalties, forgiving penalties, forgiving interest, and all those things. And those are places where FRS can do where there is need to. So as far as we are concerned, we understand the business environment and as much as we can help. And that is why last year, if you see, we did some form of, should I call it a palliative, to look at people who were supposed to pay taxes in Forex and say, okay, if you could pay that tax in Naira in an exchange determined by the CBN at that time, it will be allowed. And those are the little things FRS can do to cushion the effect of such exchange Forex issue. And we are talking about FX losses. You also mentioned that some are even cashing out. Even at this time, we are talking about losses. Are we talking about their gains too? And to what extent, as most of these people also declare the gains from such effects and pay tax appropriately. So we need to look at both of them and see what we need to do. FRS have been trying to do what we need to do, what we can do to support the business industry, and we continue to do that. Thank you.
Okay, thank you very much, Mr. Femi. I think the point is well noted. I guess what we were pushing to here, which you've clearly stated, and the FRS has done at many instances in the past, which you've mentioned, is to see how you as the regulator, if it needs to push legislation, you can push legislation. If it needs to do such acts that are within your statutory limits, that would help taxpayers that are being faced with a very, very volatile situation when it comes to foreign exchange in Nigeria. So we have said that if you have questions, right, you can still put them in the chat box so that we can ask our panelists those questions. But at this point, I will just call on the chairman of the taxation committee, Kelechi Ogbevara. She will take it from here. She will speak to some other issues and then thank everyone that has come. And then I guess we will be wrapping this up soonest, as I know we are already running above time. So I'll call on Kelechi Ogbevara to take it from here. Thank you.
Thank you very much, Samuel. That was an excellent session. I want to believe that everybody has something to take away from our session today. So I'm just giving a quick vote of thanks because we are already outside our time limit. And I'll start by thanking our panelists, to Ugochi, Chiwendu, and Mr. Olarinde. Thank you very much for honoring our invitation. Thank you for your insightful conversations today. And we hope that in the near future, if we have another session and we call on you, you would come to our sessions again as well. I'd also like to thank the NBA-SBL chairman, Ms. Dr. Adeoye Adefulu. These sessions that we have from time to time, different committees have all these sessions. And of course, this is the one that has been held by the Taxation Committee. We want to thank him for his insightful leadership. And then we also have in attendance from the beginning of our webinar till now, one of our council members, Mr. Baba Alokolaro. We want to thank him for being present here today. And then also say a very big thank you to the Taxation Committee members, particularly Kelechi Ibe is here as well. And of course, I've already said thank you to Sam. Thank you to Rex and Endurance for being the backbone of NBA-SBL. Thank you for your support. Thank you. Without you guys, this webinar today would not have been a success. And then I'd also like to thank you, the audience, everyone that has participated in this webinar. Thank you for attending. We look forward to having you in the future when we have our future webinars. Thank you very much. And good afternoon.
Thanks a
Right.
lot.
You're welcome.
Thank you, everyone. All
Thank
right.
you.
Thank you.
Thank
Have a
you.
great day.
You too.